Ed Graybeck is a strategist in the global debt markets and an expert in the bond insurance and rating agency industries. He's also given one of the earliest warnings to investors of the global financial crisis. I sat down with Ed this past December and talked about the rating agency's role in assigning ratings to public finance bond issues. In that discussion, Ed had warned about escalating political and governance risks in many state and local governments, which could ultimately lead to losses for many municipal bond investors. In that interview, Ed asserted that individual investors are better at evaluating these risks and suggested they do their own research instead of relying on the ratings of, say, Moody's, S&P, and Fitch to inform their municipal bond investment decisions. Before we get too deeply involved in the governance and political risks, first, can you explain to us exactly what is the difference between a political risk and a governance risk when it comes to municipal bonds?
Well, first, I'd like to thank you for having me here today, Stephen. But what's the difference between political risk and governance risk as far as bonds go? I would say political risk is basically that the governmental unit, whether it's a sovereign or state or a local municipality, decides, despite the bond documentation, not to pay. And what I call governance risk is basically unresolved political risk. For example, like in the case of the U.S., slavery was unresolved political risk from 1789 through about 1866. There are different types of governance issues arising over time. As you've seen, as we mentioned last time, as far as municipal bonds go, unfunded pension liabilities are a big governance risk of many state and local governments in the U.S. And the reason for that is basically none of the affected institutions seem to be willing to handle the obligation to properly fund pension liabilities. They kick the can down the road. Yep. That is a governance risk.
Okay, it's really interesting. And you think that individuals are better at analyzing these than, say, ratings agencies like Moody's, like S&P, like Fitch. Why is an individual investor better equipped to analyze them? Rating agencies have like a field of analysts.
That's true. That's true. However, the rating agencies basically are bound by the documentation and the prior models that they have that is in front of them. For example, like they can look at unfunded pension liabilities. They'll basically do probability-based analyses on is that municipality likely to default on its debt obligations given the state of the local economy, these macro assumptions. But where they get caught, where they get blindsided, is on basically out-of-the-box issues, governance issues. Simply, the things that do not appear in the official statements of the municipality that they have to file with the SEC for the bond issue. And a great example of that is the matter of sanctuary cities. None of these are mentioned in official statements.
Yeah, I would love to hear more about how sanctuary cities may pose a risk to municipal bond investors. This would be a great topic for our next segment. Will you come back with us?
I'd love to do it, Stephen.
That's terrific. Very nice to have you here. Ed Graybeck, global debt strategist, CEO of Tempest Advisors. Really great to have you here. Thanks so much for coming. Join us next time as we explore more about sanctuary cities. In the meantime, visit Traders Academy for a complete educational course about municipal bonds and use the Global Bond Scanner through the IBKR website or in the IBKR Trader Workstation to locate munis available to trade in the secondary market, along with U.S. Treasuries, corporate bonds, non-U.S. sovereign debt, and more. I'm Stephen Levine with Interactive Brokers.